Here's a second example of doing the full tax process. In this example, we have Salima. Salima had $112,000 of income from wages and $900 of taxable interest. During the year, she made $6,000 in contributions to a tax-deferred IRA. Salima has no dependents and files under the single status. So what I have here is a table for the single tax bracket for year 2022. And I also have the standard deduction listed at the top of the table because we may need to use it to compare with for someone filing a single in 2022. Her itemized deductions came to $9,500. Let's go ahead and calculate the tax she owes. And then on the next slide, we'll actually look at see if she still owes money or if she has earned a refund. All right, so again, the first step is to calculate gross income. That means the total income. Gross or total or interchangeable in this sense. So she's got $112,000 of income and she had $900 of taxable interest. So adding that together, she has $112,900 of gross income. Next, we're going to adjust that based on this $6,000 she made in contributions to her IRA. So we can simply subtract $6,000 from what she actually had for her gross income. That will give her an adjusted income of $106,900. So there's her adjusted gross income. Next, we're going to look at taking out the deductions. And again, you're going to compare her standard deduction and her itemized deduction. Her itemized deduction was $9,500. The standard deduction here is $12,900. We always want to take the one that's better, that will reduce her tax burden more. So she would like to reduce her income by as much as possible before tax gets created. So that turns out to be the standard deduction in this case. Standard deduction is more than her itemized deduction. So for her, it's beneficial to subtract the standard deduction. Sometimes it's better to do standard, sometimes it's better to do itemized. You just need to actually compare to see which one. So if I subtract $12,900 from what we had before, I will get $94,000 even in taxable income. Once we have the taxable income of $94,000, we can then go to step 4, which is calculating the tax with the tax table. So look for that income of $94,000 in the first column of the tax table. So $94,000 would actually be between $89,000 and $170,000. So looking across in the table, we get a formula for calculating Salima's tax. Specifically, we're going to take $15,213.50 and then add to that 24% of the amount that she earned over $89,075. So let me erase my arrow there so I have a little more room to work with. So I have $94,000 that she has in taxable income, and I'm going to subtract to get the amount over $89,000. I'm going to subtract $89,075. So doing that full calculation in a scientific calculator using the parentheses and making sure you've got the decimal in the right spot, what we get is that Salima is going to owe $16,395.50 in taxes. $16,395.50 in taxes. So that would be her tax that she owes. All right, so we've worked out how much she owes, $16,395.50. What we can now do is look at what she's withheld and whether she has any tax credits to work out whether she gets a refund or needs to pay more. So Salima did not qualify for any tax credits. Sometimes that's just the way things happen. So no tax credits for her, so we don't reduce the tax by anything. So next we look at her withholdings. So she owed $16,395.50. and she had $15,900 that was withheld or basically paid. So when we look at which one is more, she actually owes more. So that means she continues to owe because she hasn't paid the full amount. How much she still owes would be gotten from subtracting what she's paid from what she owes. So we subtract how much she's paid, that $15,900, and we get that she still owes $495.50, still owed to the feds. Okay, so sometimes the withholding is enough that you get a refund. Sometimes the withholding is not enough to get a refund and you have to still pay. Your employer, or you, if you're working for yourself, will try to do your best during the year to pay in so that you get closest to either getting zero refund or having to pay very little, because the idea is to just get that, if you can, get that exact. But in this case, she hasn't paid too little. She's had too little withheld, and so she owes a little bit of money. One last question here. Remember how we talked about effective tax rates? This $16,395 came from Salima paying 10% for her first bit of income, 12% for her next bit, 22% for her next bit, and 24% for the final bit. So she was paying 10%, 12%, 22%, and 24% for different parts of her income. To work out her effective tax rate, we're going to get an average of that. And we basically do that by taking her amount that she owed, $16,395, and dividing that, $395.50, and dividing that by her income, I should say taxable income, which was $94,000. And that gives us an effective tax rate of about 17.4%. This is the average of that 10%, 12%, 22%, 24%. That kind of averages those together. So her effective tax rate, when you look at what she paid in taxes compared to her taxable income, is 17.4%.